Hey everybody, welcome once again to another episode of Investing in Real Estate. I'm Clayton Morris, your host. This is the show where we focus on building passive income, and the vehicle that we use to get there is buy and hold real estate. We talk about holding it for the rest of your life in order to take advantage of all the amazing benefits of real estate investing, including not just the cash flow, of course, we talk about, but the tax advantages and setting up a business and making sure you get all of the beautiful benefits around your taxes. And that's what we're going to talk about today here on the show. You know, we talked about taxes here on the show before, but today we have a special guest to talk even deeper about taxes. My guest is Cody. He's a certified public accountant, certified tax coach, business owner, and a former New York City police officer with 17 years experience on the force. In addition to being a certified public accountant for the past 17 years, he's also a certified tax coach, which is great. He's also the author of a book called Tax-Free Life and recently authored The 10 Biggest Tax Mistakes That Cost Business Owners Thousands. And we'll get into some of those mistakes today and how you can save a lot more in taxes. Plus, Craig's going to give away a free book, which we'll have in the show notes of our page here. So when you go to our show notes page, check it out. We've got a free link to Cody's book that everyone can download and read. Cody, welcome to the show.
Oh, thank you very much for having me.
So Craig, how did you get started with, it was 17 years with a police officer, as a police officer. How did you make that switch? How do you go from that to deep diving and swimming in the tax code?
I kind of put it like this, the adrenaline rush you get when you're chasing a perp down the street. When I sit down, I save you $20,000, $30,000 in taxes. That's the same adrenaline.
I love that. Because it can be such a wonky thing to be deep diving the tax code. We've had guests here on the show before who talk about how much they love the tax code and having to stay up on it, reading it every year with all the changes that come out. Does that sound like you?
No, I don't think, I wouldn't say I love it. I love what you can do with the tax code, okay, and the benefits that you can derive if you really, do some planning. But I definitely can't say I enjoy reading it.
That's great. Well, you, as a tax practitioner, you're one of the few or select group of folks who, throughout the country, who undergo this extensive training and this sort of continuing education for tax planning. In 2017 and into 2018, just at a high level, before we dive into some of the mistakes that people make and how people can mitigate some of their taxes through real estate investing and being a business owner, when you look at just sort of the current tax code that Congress has given us, what sort of big changes have you noticed, and are you seeing some other changes that we need to be aware of?
No, I'm not seeing any major changes. There's some little things going on with depreciation, but nothing major. I think, people just really need to focus on, planning and knowing, planning for what's there today versus what may happen tomorrow.
Okay, great. So no major changes coming. Are you hopeful that we're going to see some big changes to the tax code under the president's plan? And we know he wants to change the corporate tax code and then try to tackle individual tax reductions and all of that. But based on how healthcare just seemingly collapsed, are you hopeful that we're going to get some tax changes?
I'm no longer hopeful, no. A couple of months ago I was, but no, not anymore.
Yeah, I do believe it could buoy a lot of investing in this country if we could see some major changes to that and a reduction in the tax that corporate tax rate. But I'm not hopeful either. It would be great to see, but I don't think we're. It
would be nice. It would be nice. I don't see it happening, but people just take that. There's a lot of things in the tax code that people are not taking advantage of.
Right.
Today.
So let's dive into some of those things that people are not taking advantage of today, and let's deep dive each of them. You want to give me your first on your list here?
I would say the first is, failing to plan. People are typically, going to their accountant in March and April, and, he's looking in the rearview mirror and he's doing compliance work and putting the right numbers in the right boxes. But there's nothing proactive being done where, people spend time looking for a car, researching a car, but they don't spend any time researching the taxes. What can they do differently?
Right. So planning, researching your taxes. And then what are some of the things that people are not taking advantage of?
Oh, some of the things that family employment, medical benefits, a home office, car and truck, the right depreciation, cost segregation, Those are just a handful of things that people are not taking advantage of. And cost segregation can be huge.
So let's dive into some of those. So employment, let's break those down a little bit, if you don't mind deep diving some of those. What are the benefits of each of those?
Okay, so let's think of family employment. Okay, the tax code, basically in the courts say you can hire your kids at the age of 7 to do work for your business. So depending on what your business is, it could be riding by your properties every week or every day, and pay them a reasonable wage, and then those kids are basically taxed at a zero rate on the first $6,000 worth of income. So say you have a kid going to private school or going to hockey camp or sleepaway camp, you can pay that child and then have the tuition come out of his bank account and basically get a deduction for the tuition or the camp, whatever it is.
That's great. Well, we do that with our kids, and we were advised on that early on, which is to put our kids to work, and so we have them help clean up the office. We have the 2 home offices, and go through, and they love the shredding of when we print out bank statements so we can balance our checkbooks, and then my wife has them shred them in the shredder, and they love shredding it. It's like, okay, we got a stack of all these statements, go here, shred it. We got to throw this stuff out, and they love it, and that's part of their job.
That's right. You get a tax deduction for that, and it's legal.
Right. That's great. That's great. So family employment. Okay, that's one checkbox. What else? What else can we?
Medical benefits. There's something called a Section 105 plan, which is a medical expense reimbursement plan, depending on what type of entity you have. And typically you can do that with real estate, where you're basically hiring your spouse, but her compensation is not a wage. It's a medical expense reimbursement plan, and you get to use that to pay all of your out-of-pocket medical costs, whether it's eyeglasses, contacts, co-pays, etc., and make those expenses that are normally really not deductible, because to take a deduction for them on your personal return, they have to exceed 10% of your income. So most of us, thankfully, don't hit that criteria.
So explain that a little bit more. I've never heard of this before, and I'm immediately jotting down notes here and going to tell my wife we got to start figuring out how to do this. So if we are co-partners in our LLC, right, how would that work? Give me
it's a Section 105. It's a section under Section 105 of the Internal Revenue Code, and it basically allows you to hire, let's just say, your spouse. And then that medical expense reimbursement plan covers your spouse and their children and their spouse, and you get to deduct those out-of-pocket costs.
So that's different than, say, like a flex savings plan or something, right? I mean, like a flex saving plan that I might have through my employer that I sort of front load a number of money into that flex savings account for medical benefits or medical, certain different things, eyeglasses and things. This would be different, right?
This would be over and above that. If you have that kind of plan, you would use this for stuff over and above that. But a lot of people don't have that type of plan.
Interesting. Okay. Wow. Good to know. Good to know. Okay. You talked about vehicles as well. How can we use our vehicles for our business?
Well, let's say you have a home office, which is, something that you should have. Okay. If you're working out of your home.
First of all, before we even go there, how does the tax code allow for a home office? I know there's specific criteria for that. Doors, closets, stuff like that?
Well, no, you need to have a space that you use basically just for that activity. So let's just call it a room. I wouldn't go into a closet. Let's call it a room. And then that space has to be the principal place where you perform certain activities for that business that you're in. And certain activities could be administrative stuff. And you need to spend at least 12 hours a week working from that location, all right? And then it qualifies. And the wonderful thing about it qualifying is once you have a home office, then you could have a home athletic facility. And that home athletic facility could be a gym, it could be a pool, and that facility is for your employees and their families. So you get to write off your gym, you get to write off your pool.
Wow. You can write off a pool?
Yes.
How does that, so if I decided I want to put a pool in my backyard, how does that work?
You would be able to appreciate that pool, and you could write off the operating expenses for that pool, as long as it's really for the use of your employees.
And our employees would live here. They just happen to live here.
Correct.
Wow.
And then once you have that home office, now your mileage from your home office to your other locations where you work becomes deductible.
What about electric vehicles? Is there any sort of difference for that under the tax code? I know different states have different benefits for buying an electric vehicle for the business. California and different things. And California is now considering, again, an added benefit. I just read it in the front page of the Wall Street Journal this past week. Anything benefit there?
Okay, so normally we don't get that involved in electric cars because it's more on a state-to-state level. And it becomes a lifestyle choice for the individuals that, people typically want that electric car because, they're looking to do something good for the environment. And each state has its own rules and what type of, subsidies or tax credits you're going to wind up getting.
Great. Okay, so we've got vehicles, we've got family employment. Are there any other nuances to family employment that we need to talk about? Or
you need to make sure you document what they're doing. They need to be paid a reasonable wage. Right, so you can't pay them $50 an hour to shred documents, and you should have a documentation system where you document when they start work, when they end work.
Okay, and is there a website? Does IRS have like something specific on their website that lets you figure out what a reasonable wage is?
We use software for that. There's probably stuff out there that the IRS has, but we use a special software for figuring out what reasonable compensation is.
Okay, so this is yet another reason why you want to definitely work with a smart CPA like Craig to figure this out and help you along in this path. What about so we have the amount of hours that they need to work. We have that we're the bookkeeping that we're keeping up. Is there a certain amount of hours that these kids need to work in order to have them take advantage of that? And what about and laws that would forbid them from working too many hours? Like if I wanted to put my kids to work for 60 hours a week, is that okay?
Probably not. I wouldn't recommend that. Okay.
I would love it.
I don't want ACS knocking on your door.
Right. Today's episode is brought to you by Eero. Do you have really crappy Wi-Fi in your home? I'm probably pretty certain that you do, unless you've bought an Eero. What is an Eero? It's a distributed mesh network for your home. Now, if you've ever walked into a Best Buy, you've seen those like range extender routers that have the funny antennas sticking out of them. Those are terrible. That's not what Eero is. They don't extend one of your routers. You have a couple Eeros set up throughout your home. They're super simple to set up. And they all talk to each other, and they create like a big spider web known as a mesh network. So no matter where you go in your home, you're going to have super fast, reliable Wi-Fi. Now, I've got a basement. I've got 3 floors that go up to an attic space that's a loft where our kids play. It's a tall colonial house. We have Eeros in a couple of different rooms, and we have super fast Wi-Fi all over the house. The router is downstairs in one room, but that doesn't mean that up in the attic, the Wi-Fi is slow. The Wi-Fi is just as fast up there as it is downstairs in the kitchen, thanks to Eero. No more dead spots. And guess what? Eero just came out with their 2nd generation, which I love. So it's now twice as fast, and it has tri-band technology built in, which means that so many, folks in your family can be on the router at the same time, can be on your Eeros, streaming Netflix or doing whatever they're doing, texting, and it's all consistently fast. So, and what's great too about it is it uses the low power now. So if you've got like a Ring doorbell, or you've got some of those internet connected light bulbs or devices that don't require a lot of energy and don't require a lot of network speed to communicate, they will even cover those now in such a great way. Because we had a Ring doorbell that really, on the backside of our house, it didn't really connect to the internet all that often. It was spotty. And then when we got the 2nd generation Eero, it's never, ever offline. It's always connected. So someone rings our doorbell, we're able to connect right to the internet and see who it is. So the 2nd generation Eero is out now. And also they came out with a beacon, the Eero beacon. Now, what is this thing? It's a small white box. It's elegant. It looks beautiful. It looks like a nightlight. You plug it right into an outlet, and it'll extend your network even further. So you don't even have to plug it into anything else. You just plug it right into the outlet. It has a nightlight built into it as well, which is really, really cool. So we have it down in our basement, actually. And so if I come down here to grab something and I don't put the lights on, the Eero beacon is right there with a nice little night light. And guess what? It's extending our whole family network. So we can stream Netflix in the basement and do all of that stuff. It's really fantastic. I love these guys. It really has changed the way that we look at Wi-Fi in our home. No more dead spots. No more dead spots. Go, and guess what? They're going to give you free overnight shipping just for working with us. If you use the coupon code INVESTING, when you check out and you buy them, so go to EERO, that's eero.com, EERO, and then use the coupon code INVESTING at checkout, and you'll get free overnight shipping on your new, fast, reliable Wi-Fi. I love these guys. Thanks, Eero. So we have vehicles, we have the family, we have the medical reimbursement, which is great. What else are people overlooking?
In the real estate field, we often see people overlooking, the correct depreciation and cost segregation. I could go into explaining what cost segregation is if you'd like.
Yeah, it's a little complicated. So I know we've covered it a little bit here on the show, but it's worth repeating. And, I know that some of the laws, obviously cost segregation has changed over the past few years, so we can take advantage of other things now. So yeah, explain what it is and how we can take advantage of it. So
typical, you'll see somebody, let's say, buy a residential rental property. And let's just say the land is worth $100,000 and the building is worth $200,000. So they'll depreciate that building over 27 and a half years. So let's just say that comes out to $8,000 a year in depreciation. When you do a cost segregation study, you break the components of that house up into 3-year property, 5-year, 7-year, 15-year. So you're actually going to depreciate more upfront, okay, than you would in the initial years on the straight line, 27 and a half years. So over 27 and a half years, you depreciate the same amount of expense. You're just able to get more upfront. And the wonderful thing about cost segregation is maybe you haven't done a study and you own a property for 5 years. You could do a study in the 5th year and you could recoup all that depreciation that you would have taken that you missed.
Okay. And you need to hire someone, though, specifically to handle doing cost segregations, right? You can't just do this on your own.
No, most people can't do that on their own. You could hire, there's a number of companies that do it, and we actually use a company that has developed software with algorithms for, I would say residential properties that are valued at less than $500,000. That makes it very economical to do.
Gotcha. So that's a great. And do you want to weigh whether or not you want to spend that money on doing it? Does it make sense if you're a real estate investor, you've got 1 property, 3 properties, or do you want to wait until you have 10, 15 properties? What is there like a rule of thumb for that?
Not really. Everyone's situation is a little different. Number one, do you have income? Do you have a net income, or you're already at zero? Do you have other sources? If you're at zero, you have other passive income that could, absorb the losses that your real estate may be generating. So it's you have to take a bunch of different things and look at them together.
Gotcha. Okay, great. Now let's dive into some of the mistakes. As you write about, I want to talk about some of the mistakes that people make. Obviously, I think we were talking some of the mistakes already that people are just ignoring. But can you walk through some of those? You mentioned 10. We don't have to get to all 10, but it'd be great to give some high level.
Well, failing to plan is one. Audit paranoia. People think, if I do this, I'm going to get audited. Well, if you do something right and you get a notice, you have the documentation to back up what you did. Doing something and not documenting it and doing it wrong is a mistake. Okay, but audit paranoia should not keep you from doing something that the tax code allows you to do.
Yeah, that's a great piece of advice because so many people, the tax code is there for you to use. And it encourages entrepreneurship and investment and not taking advantage of it because you're worried about an audit. If you're doing things right, then an audit should be fine, right?
Correct. I mean, nobody wants an audit.
Right.
But, that should not be what's keeping you from taking advantage of what you're legally allowed to do.
All right. So failure to plan, audit paranoia. What else?
Another one you see in real estate is the wrong business entity. Okay. Do they own it in their name personally? Is it in an LLC? Is it in a corporation? Why is it in a corporation? Really, what's the best way to hold that real estate? So we see that quite often.
What are the biggest mistakes that people make with that? They're just holding it in their own name?
That's a huge one.
Yeah.
Okay. And we've seen clients where it's cost them a lot of money. They think, well, I have insurance, I have an umbrella policy, and, maybe it's mold that, a lot of policies cap out at $25,000. You get sued and it's $150,000, and maybe the property's only worth 50.
Right.
We've seen stuff like that. So it's always good to, speak with your attorney, and basically, if you really want to do it the right way, have your attorney and your CPA speak together and figure out what's the best entity to hold your real estate in. And more often than not, but not always, it's going to be an LLC.
Yeah, that's what we have ours in, and we have it reporting up to a holding company. Our individual LLCs that own our properties reporting up to a holding company. How do you feel about holding companies? How do you feel about the amount of value in each LLC? Is there?
I personally rather see each property in its own entity, because you never know when something's going to go bad. In a place like New York, where it's probably cost you about $1,500 to create an LLC, it's well worth it. God forbid something happens.
Now, if our typical property is cost about $45,000. We've put about 2 or 3, maybe 3, roughly 3 properties in one LLC has kind of been our going rate. So about $150,000 up to $200,000 in value. Does that comport with what you think? Or I know New York properties are a lot more expensive.
Right. Well, it really comes down to are you okay with that level of risk? So God forbid something happens in one of those properties and it's not covered by insurance. Are you okay with possibly losing all 3 of those properties?
Right. Right.
And, are they leveraged or are they not leveraged?
Right. They're not leveraged. Yeah.
So if they're leveraged, obviously your risk is a lot less. But if they're not leveraged and you own them all free and clear, would you risk that $50,000 for, in a lot of states, what might amount to, a couple of $100 to form an entity? And if they're reporting up to a holding company or a management company, they're typically going to be single member LLCs. So it's not like you're paying for an extra tax return in there.
Gotcha. Right. Because they're passing through. Okay. Makes a lot of sense. So among the other mistakes that you see that cost business owners thousands of dollars, we talk about the liability and holding those properties. What else do you see people making mistakes around?
Let's see. We have family employment. Retirement plans typically don't come into play that often in real estate, because then we're dealing with self-employment tax. Medical benefits we talked about, the home office, car and truck expenses, meals and entertainment are not a big thing in real estate. I guess the big thing would be, not communicating with your CPA or your tax practitioner, missing out on that, and not having your attorney and your realtor, and if you're using a realtor, and your CPA communicating.
Right. Having those discussions, and because as our accountant has said, look, having those discussions throughout the year make filing taxes fairly easy. That it's all the prep ahead of time that makes filing the taxes that becomes the easier portion of it. Correct.
Yes. It's planning.
Right.
Taking the time to plan versus looking in the rearview mirror. And looking in the rearview mirror, you can't really do much.
Oh, that's great. Well, any parting words of wisdom, Craig, before we let you go? Obviously, we want people to take a look at the book. We've got the link on our website so people can download a free copy of your latest book. If you just go over to morrisinvest.com/podcast, you go to our show notes page, you can download that. But any parting words of wisdom before we let you go?
No, just take the time and spend a little time planning, and you'll reap the benefits of the tax code.
Yeah, it's there for you to take advantage of.
Basically, keep more of what you make.
Right, which we'd all like to do.
Yes, exactly.
We would all love to do that. Well, Craig, it's been my pleasure having you here on the show, diving into some of these mistakes around taxes. Thank you so much.
Thank you very much for having me. Have a great day.
Thank you. And thanks to all of you for downloading and subscribing and making this a part of your weekly education around real estate, buy and hold real estate, especially the tax code, which can be a little scary, but if you get your arms around it with experts like Craig, then it doesn't have to be so scary. We publish this show 3 times a week, everyone. We'll be back here on Monday with another episode of Investing in Real Estate. Until then, go out there, take action, and become a real estate investor. We'll see you next time.